Welcome to Learn with Kern, brought to you by SoftLogic Stockbrokers. Today in lesson 4, we are going to look at some of the most common jargon you will hear when people talk about the Colombo Stock Exchange. Now don't let that word jargon scare you. It simply means the special term or language used in the stock market. I'll be breaking each one down for you in very simple everyday language with examples that connect to our Sri Lankan market. So it's easy to understand and remember. By the end of this lesson, you will be able to follow a stock market conversation without feeling lost.
Bull and bear market.
A bull market is simply when share prices are generally rising and investors feel confident about the future. It's a period of optimism. For example, if the all share price index ASPI on the Colombo Stock Exchange keeps moving up steadily over a few months, that's a clear sign we are in a bull market. In this kind of market, investors are excited and willing to put more money in. There are more buyers than sellers. Share price keep climbing higher. So in short, a bull market means good times in the stock market. People are positive, confident, and expect prices to continue rising. A bear market is the opposite of a bull market. It's when share prices are generally falling and investors feel uncertainty or even fearful about the future. For example, if the ASPI on the Colombo Stock Exchange keeps dropping steadily over several months, that's a sign of a bear market. In this kind of market, investors lose confidence and hesitate to invest. There are more sellers than buyers. Share prices keep moving lower and lower. So in short, a bear market means tough times in the stock market. People are cautious, negative, and expect prices to fall further.
ASPI, All Share Price Index.
The ASPI or the All Share Price Index is one of the most important measures in the Colombo Stock Exchange. It represents the overall performance of the entire market. When the ASPI is moving upward, it indicates that on average, share prices of most listed companies are increasing. When they move downward, it reflects that overall share prices are declining. What makes the ASPI significant is that it doesn't focus only a few large companies. It considers all the companies listed on the exchange, from leading corporates such as John Keells and Commercial Bank to much smaller firms. Because of this, the ASPI provides a reliable picture of the general health and direction of the Sri Lankan stock market.
S&P SL20 Index.
While the ASPI captures the performance of the entire market, the SL20 index focuses on the top 20 companies of the stock exchange. These are the strongest, most liquid, and most actively traded companies, names such as John Keells Holdings and Commercial Bank. If you want to gauge how the market leaders are performing, the SL20 gives you that snapshot. It highlights the companies that carry the most weight and influence within the exchange, making it an important benchmark alongside the ASPI.
Market capitalization.
Market capitalization is simply the total value of a company as measured by the stock market. It is calculated by multiplying the current share price of the total number of shares in issue. For example, if Dialog share price is 20 and the company has 1 billion shares outstanding, its market capitalization is 20 billion. In other words, the value of the marketplace of the company. To give a broader perspective, the total market capitalization of all listed companies on the Colombo Stock Exchange is currently rupees 7 trillion. This figure reflects the combined worth of every company traded on the exchange, making it a key indicator of the overall size of the value of the Sri Lankan stock market.
Board lot.
On the Colombo Stock Exchange, investors can technically buy even a single share. However, in practice, shares are usually traded in standard units known as board lots. A board lot typically consists of 100 shares, and this is considered the normal trading volume for most transactions. This system makes the market more efficient by keeping trades consistent and orderly. That said, if you wish, you can still purchase a smaller quantity, even just one. But board lots remain the standard for active trading.
Bonus issue.
Sometimes, instead of paying cash, companies reward their shareholders by issuing bonus shares. These are additional shares given free of charge based on how many shares you already own. For example, if you hold 5 shares and the company declares a 1 for 5 bonus, you will receive 1 extra share at no cost. It's a company's way of strengthening shareholder value and rewarding loyalty by giving you a large stake in the business.
Rights issue.
A right issue is a way for a company to raise additional capital while giving priority to its existing shareholders. In a right issue, shareholders are offered the opportunity to purchase extra shares at a discounted price before the shares are made available to the public. This approach rewards loyal shareholders by giving them the first chance to increase their stake in the company while also helping the company raise the funds it needs for growth or other initiatives.
Dividend.
Dividends are the portion of a company's profits that is distributed to its shareholders. Companies may pay dividends in cash or in some cases as additional shares. For example, Caltex Lubricants regularly pays dividends to its shareholders, providing a tangible return for owning part of the business. Dividends are essentially a way for companies to share their success with those who have invested in them.
Broker.
You cannot directly buy or sell shares on the Colombo Stock Exchange as an individual investor. To participate, you need a licensed stockbroker who act as your intermediary. Firms such as SoftLogic stockbrokers are authorized to execute your trades, guide you through the process, and provide access to the market. Essentially, your broker is the link that connects you to the exchange and ensures your transactions are carried out efficiently and securely.
Margin trading.
Margin trading allows investors to increase their buying power by borrowing money to purchase additional shares. For example, suppose you have 50,000 to invest, but you spot on an opportunity to buy shares worth rupees 100,000. Through a margin provider, typically a bank or licensed stockbroker, you can borrow the additional rupees 50,000. The provider lends you the funds, enabling you to double your investment capacity. Of course, the borrowed amount comes with interest, which you need to pay back. Margin trading can amplify potential gains, but it also increases risk, so it should be used with care.
Circuit breaker.
The Colombo Stock Exchange has safety mechanisms known as circuit breaker to maintain orderly trading during periods of extreme market volatility. If the ASPI rises or falls more than 5% in a single day, trading is temporarily paused. This pause gives investors time to assess the situation and prevent panic-driven decisions, helping maintain stability in the market.
Settlement cycle. T+2.
When you buy or sell shares on the Colombo Stock Exchange, you don't need to settle payment immediately. The CSE follows T+2 settlement cycle. Here is what that means. T stands for the transaction day, the day you execute the trade. +2 indicates that you have 2 business days after the transaction to complete the payment if you are buying or to receive the funds if you are selling. This system provides a short grace period, ensuring that all trades are processed smoothly and efficiently.
Liquidity.
Liquidity refers to how easily a share can be bought or sold in the market without significantly affecting its price. For instance, large companies like Dialog typically have high liquidity, meaning there are always buyers and sellers available. In contrast, smaller companies may have lower liquidity, which can make it more difficult to buy or sell shares quickly at a fair price.
Volatility.
Volatility measures how much and how frequently a share price fluctuates. For example, blue chip companies such as John Keel's Holdings tend to have relatively stable prices. In contrast, smaller or lesser established companies may experience significant and rapid price swings, reflecting higher volatility. Understanding volatility is important for assessing the level of risk in your investments.
Limit order.
A limit order allows you to specify the exact price at which you are willing to buy or sell a share. For example, you might instruct your broker, buy NDB shares only if the price drops to rupees 135 or lower. This gives you control over the price you pay or receive, rather than accepting whatever the market offers now. Limit orders are a useful tool for maintaining risk and executing trades according to your strategy.
IPO. Initial public offering.
An initial public offering, IPO, occurs when a company offers its shares to the public for the first time and become listed on the stock market. For an example, a family-owned bakery in Colombo looking to expand nationwide might invite the public to invest by buying shares. The first sale of shares to the public, the moment the company goes public, it's what we call an IPO.
Portfolio.
Your portfolio is the collection of all your investments, which may include shares such as Dialog, HNB, Hermas, as well as bonds or unit trust. A well-constructed portfolio aims for a diversified mix of assets rather than concentrating on a single type of investment. Diversification helps spread risk so the performance of one investment doesn't impact overall returns.
Day trading.
Day trading involves buying and selling shares within the same trading day without holding them overnight. For example, you might purchase shares in the morning and sell them before the market closes, aiming to profit from short-term price movements.
Why some investors choose day trading?
It offers the potential to make quick profits within hours if the share prices moves in your favor. Brokerage costs can be lower as brokers charge fees only on one side of the transaction when shares are bought and sold on the same day.
However, there are risks.
Share prices can fluctuate rapidly. Losses can occur just as quickly as gains, making day trading a higher risk strategy that requires careful attention and experience.
Foreign institutional investor, FII.
Foreign institutional investors, FII, are large investment entities from overseas, such as mutual funds or pension funds. When FII invest in the Colombo Stock Exchange, They bring significant capital into the market, which can drive share prices up. Conversely, when they withdraw their investment, the market can experience sharp declines. Understanding FIA activity is important as it often influences overall market trends and sentiment.
Price to earnings, PE ratio.
The price to earning ratio, PER ratio, indicates how much investors are willing to pay for each rupee of a company's earnings. For example, if ABC company has a PE of 10 times, it means investors are paying rupees 10 for every rupees 1 of the company profits.
Bear trap.
A bear trap occurs when the market gives a false signal that a declining trend will continue, but instead price reverse and move upward. It can catch traders off guard, particularly those who act quickly on the initial downward signal, highlighting the importance of careful analysis and risk management in trading.
Blue chip stocks.
And finally, let's talk about blue chip stocks. Blue chip stocks are shares of large, well-established companies with a strong track record, solid financials, and a reputable presence in the market. These companies are typically leaders in their industries, offering relative stability and reliability for investors, making them a cornerstone of many long-term investment portfolios. So these 22 terms are the building blocks of stock market language. Once you understand them, you will find it much easier to follow the news, talk to your broker, and make smart investment decisions. Stay tuned for lesson 5, where we will cover the top mistakes new investors make on the Colombo Stock Exchange. Understanding these pitfalls and learning how to avoid them will give you a strong foundation for becoming a confident and successful investor.